Welcome to the Capital Spotlight, where we interview institutional capital allocators to learn more about their strategies, sponsor and investment criteria, due diligence process, and asset management practices. I'm your host, Rob Beardsley, and today we are having a discussion with JC Clemens with Flagship Capital. Thanks for coming on.
Happy to be here.
Well, very cool. Well, tell everybody what you do at Flagship and what you guys are focused on.
Yeah, absolutely. So JC Clemens, Flagship Capital. My background, I was at HFF, I guess now JLL, for approximately 7 years. I spent 4 years on the mortgage banking side as an analyst, underwriting and doing loan packages and really cutting my teeth in the industry, working for some of the top producers based here out of Houston. And then at the end of 2014, I moved up into production on the multifamily investment sales team, where I sold everything from high-rise, shiny towers all the way to B and C and D multifamily deals that had a couple hundred down units on them. So really got the full spectrum of multifamily there. And then at the end of 2016, I decided to move over to the principal side of the business. And that's whenever I landed at Flagship Capital Partners. Flagship Capital Partners is actually a second iteration of Flagship Properties Corporation. So David Mintzberg is our president and CEO. Deals that need loans from the sizes of $2 million to $15 million. And so we've done just about $100 million of that business in Fund 4. That's one side of the shop at Flagship Capital Partners. The other side of the shop that Rob knows well is our equity investment platform. Historically, it's really just been a member family office to where we would syndicate each deal. And we did about $50 million of that type of business in multifamily deals all over the country. We have since raised an equity opportunity fund that is focusing on value-add multifamily acquisitions all across the U.S. And so we have $50 million that we're looking to place of that fund. And we closed our first deal in January before COVID hit. And now we're excited to have a lot of to see new opportunities and what we hope is going to be some new price adjustments out there.
Absolutely. Yeah, so definitely a lot to talk about there, a lot to start with there. So first, something I noticed and something I want to get your take on is the evolution. It could just be the evolution of that business and specifically David, your president, but would you say that as cycles mature and deals get tighter, valuations are higher, have you guys taken the approach to go lower and lower in the capital stack or safer and safer in the capital stack where the risk adjusted return is better, but maybe the absolute return is lower?
Yeah, so I think it's interesting, from David and Jared's general partnership days, whenever they were owning deals outright, David, something that his father taught him 50 years ago was if there is a buyer out there at your number, sell it. And he kept that thesis through every single cycle at time to lessen your risk or take a big bet or hop in, then I think you're really going to lose that game. I think if you have a consistent thesis throughout your entire business kind of history and your go forward actions reflect that, then I think that's what's going on. So like with all you, never be too highly levered if the market's a little hot, everybody knows that. I think that if you can just consistently have a strong investment thesis and always stick to that. And ours is really, it takes 10% to understand, 10% of our time to understand the real estate and underwrite the deal. We need to spend 90% of our time digging into the sponsor and their ability to execute that transaction.
Sure. So diving into when you started at Flagship, 2014, could be a very similar time to right now. Oil turned negative briefly yesterday on the futures contract. And, all in all, everything's going on to make a very uncertain environment for especially oil. So do you guys have experience with the previous oil downturn, specifically in Texas markets that have that exposure ranging from like a Midland to a Houston, and how'd you manage that, and how do you think that'll happen and play out this time?
Yeah, no, absolutely. So, I actually came to Flagship in 2016. So I just want to clear that up. But I do not have any experience directly in the different big oil and gas cycles as far as, like a 1980s type impact to where the industry was completely turned upside down. I was in Houston in 2014 when oil went from $120 a barrel to $20 a barrel. David and Jared have definitely been in Houston, in the 80s, in the Enron days, in the different cycles, because this city is, can be somewhat cyclical. And so I think having their insight into how we look at these deals going in on the front end has been very helpful for me, because I've only been in the industry 10 years. So my only experience is the 2014, 12020 crash. It is as bad as it sounds, but it is not as just crazily terrible as, oil's not going to trade at negative for a significant amount of time, and so Houston, the landscape is definitely going to change. I do not have any experience in the Midlands or the Corpus Christis or those type areas, or, in the Bakken, or, different shale plays out there. But in Houston, I think that the main focus is going to be, it's kind of the tale of two cities here in Houston going forward. I think it's going to be 12, 18 months, whatever it may be in Houston, until, the oil and jobs and everything start to really kind of normalize. I think where there's going to be a lot of potential heartburn in Houston is going to be on the new core Class A construction, because there's 25,000 units that are under construction right in Houston. Job growth, we have no idea what that's going to look like in Houston going forward. Population growth in Houston has been some of the strongest in the country for the past 10 or 15 years. For me, if I was putting my money in our Flagship, our focus is going to be on that DC, good basis, good demographic, close to, job drivers that are still going to be working very long. It could be 2 years or it could be 10 years. Houston is typically on top of every single chart with job growth and different indicators on how well the economy is doing down here. So going to be a little bit of a choppy ride on the front end, but nothing that city and good operators can't handle.
Makes sense. So let's jump right into today. You mentioned might be a little choppy today. You guys are still putting out capital. I think I'm getting your emails. You guys are a shining beacon in a very uncertain market right now. A lot of people are closing their doors and hitting the pause button. But you're telling me you guys are active, just close a deal. So how are you approaching and valuing acquisitions, and how has your underwriting changed given all the uncertainties?
Yeah. So I'm going to take that question kind of two separate ways. I'm going to do one on the debt side and then one on the equity side. So on the debt side, our debt fund is focused on, like I said earlier, bridge acquisition financing in Texas. And so we have a handful of deals in Houston, Dallas, Austin, San Antonio. And so going forward, we tell you that that number, a cap rate expansion of X, or that it's a decrease in, price of Y. And we're really leaning on the market to tell us what that is. And so the way that we approach that is that we're really, not going to be looking to underwrite anything that was priced or underwritten pre-COVID, because those valuations were obviously, inflated or not, it was just a different world. And so we think that, our metrics, like I said, our parameters, our, protocol as far as underwriting is going to be the exact same. It's going to be on a new market adjusted price. And so say somebody had a deal in Houston that they had under contract for 88 units, and that was in January of 2020. And they now gone back to sell, or they got the deal under contract again at 73 a unit. Obviously, if we were 75% on the 88 number, now we're going to be 75% on that 72 number. And, so that might look like a 60% loan to cost loan based on the old valuation, but on the new valuation, still makes us comfortable. Because again, our risk is really, at the end of the day, if we have to take this deal back, what is it worth? And so our metrics are always going to leave us that buffer there. And so that's really what we're looking for. Another deal that we're looking at is in Montgomery, Alabama. Every single siding on an apartment complex has a deal called Hardy Plank on it. That's where Hardy Plank is made, is in just outside of Montgomery. Hyundai has a huge plant there. There's a massive military base. There's a big lumber industry. So what we're really looking at on the equity side is for deals in kind of the central U.S., Texas, and the Southeast, just because we think that that's going to be a really good risk-adjusted return on our money going forward. Hopefully, those areas will not have been severely impacted from the impacts of COVID-19. Everybody's been hit by it, but we don't think that that problem is going to linger there as far as it will have lingered in other major metros, maybe on the West Coast or the Northeast. consistent. They're not going to swing up 6-7% annually on rent increases, but a lot of those areas have been very steady going forward, and a lot of those renters are not, majorly impacted by what happens on Wall Street, because a lot of those renters are hardworking, teachers and plumbers and people who work at Hyundai. And so if WeWork does an IPO, they don't care. It doesn't impact their day-to-day life. And I think that's kind of a thesis that we're really looking for going forward is, a demographic that's just hardworking people that want to live in a safe complex with their families or with their significant others, that are zoned to good schools, that have good jobs. And then if you just kind of stick to what we all kind of got into the industry learning, which is, good real estate in a good location at a reasonable basis and good.
Right. So it sounds like rather than changing your underwriting metrics, for example, stressing vacancy, stressing collection loss, you're just pivoting your story and seeking assets that are maybe a little more better positioned to withstand COVID-19 and a potential recession.
I think that's right, but definitely on the near term, we're taking into account the impact. So, for example, on our Montgomery deal, that deal we had under contract before COVID hit, and that deal has since gone back for a retrade. And there was two ways to approach that deal. If you just take a stone cold haircut on the deal from the seller, no matter what collections look like in the future, you got your retrade, we're closing the deal done. Or there's another side of it too that was obviously we're not doing any of these negotiations, the general partner is, but another way that we have heard of people approaching it is the seller will put X amount of money into a reserve account, and they will have that reserve account that is in control of the new buyer. It impacts on collections, but on the going forward basis, we're definitely dialing back occupancies, definitely dialing back the potential rent increases. But I think in 12 to 18 months, we're assuming business as usual on our assumptions.
Got it. So would you say this cycle rolling over, which it seems like it is causing you to look at a more longer term perspective and say, well, we previously thought we might be able to get in and get out on 3-year term. Now we might underwrite or expect to be in a deal longer just because the exit might not be there that we once thought?
Yeah. So every single one of our deals that we invested in 2015 to 16, everybody said this is going to be a 3 to 5, 4 to 7, year hold. Every single one of those deals consistently sold within, anywhere from 24 to 48 months. So every deal that was in this past cycle was on the very early end of that investment horizon. We're saying 3 to 5 years right now. I think that, probably prepared for it to look more like 6 to 7 instead of 4 to 5. And if you're a 3 to 5 year guy or gal, then you need to be prepared for the 4 to 5 instead of the 2 to 3.
So how is your fund structured? Does it give you the flexibility to be able to hold longer, or do you have a set maturity on the fund where you need to liquidate and get out?
Yeah, so our fund is a 7-year facility, and so the way that works is every deal that we go into, we have a 3 to 5 year investment horizon, and we've got 24 months to deploy our capital, and so that's where we get our real 7 years from. We have the ability to extend that. You can structure it in a way to where it is in the general partner's best interest to get us out of the deal at that point.
Right. Okay. So how do you mentioned Montgomery deal, you mentioned you're looking at Indiana. Sounds like you've got a lot of deal sources and you're looking in a broad geography. How are you sourcing a lot of your deals, and who's bringing it to you and where do these relationships come from?
Yeah, so being in business as long as David and Jared have, and even myself, there's a lot of existing relationships there on the debt side in Texas. I don't have a big network in Louisville, Kentucky, and I sure don't know a ton of people in Alabama. But the more that you go to these larger conferences, you and I were at the IMF deal in Dallas. There's some other kind of family office and investor networks. We lean heavily on the brokerage community to at least bring those deals in. And then given David and Jared and mine and our other associate Mark Barron's, given all of our backgrounds in the different cities that we've done business in over the tenures of our careers, if we get the deal on the door, find somebody that we have transacted with previously that is an investor or a broker that we can't call on in that city, and then use that network to kind of do some back checks on the deal. So on the front end, very heavily weighted on the brokerage community and existing relationships. I'd say probably 50-50. But then once we get that deal in the door, our relationships, especially David and Jared's, who've been doing this, because Jared was buying deals for Camden, all over the country. And so he knows a lot of people that are in these different states. So the due diligence process is usually us calling some people that we know after that.
So if you had describe the perfect deal, how it would come on your desk, what would it look like? What information would be included? Kind of high level, how would it be underwritten and the information would be provided, paragraph, a couple bullet points. What's the best way for you to wrap your arms around the deal?
Yeah, that's a really good question. So let me think about that. I think, on the front end, just on the initial to get me interested in the deal, because it's not like I'm too cool for your deal. It's just literally for how lean of a shop that we are, it's got to be in the headline and it's got to be in the email. So if you've got 4 pages on an email describing the deal to me, I'm literally not going to have time to read it. And so, but if your headline is, got a deal, it's the going in 6 cap, 65 a unit, 5-year IRR of X, sponsor is from Y, his net worth and liquidity is Z, please call for more information. That's going on the short list. And for me, I think it's a sponsor that owns deals in those markets. So because it always kind of irks me whenever somebody says, oh, I really know this market inside out, but it's their first time owning and operating that market. So in our Montgomery deal, the sponsor who's buying that deal owns 3 other deals in the city and owns 11 deals within 3 hours of that property. And so they do know what collections look like, and they do know the demographics, and they do know, the cyclicality of that market. So Southeast or Texas, and trying to think, going in cap rates are, they kind of are what they are. I think that those are definitely going to widen out a little bit, but I've never really been too terribly focused on that if it's a true value add deal, because the income on the front end is obviously skewed. I think that it would be definitely over 175 units. Over David's history, he said the most efficient number on every deal is 275 units. Anything above that, you don't have the efficiencies of the opera. 200, 300 units, 1975-ish to 1995, with a going in basis that makes sense. I think that, on an older vintage deal in the Southeast, call it 65, 70, on something that's a little bit newer, you can inch it up a little bit more. I think the exit cap on those deals need to be heavily in 6s, if not have 7 handle on. Just that's a very conservative exit. Everybody says, GC, you're full of shit. You can't find those deals out there. Both Pine deal and Montgomery deal are both exiting on 7 caps on our underwritings, and we're still hitting mid to high teens. And so you can find those deals if you look hard enough. And I don't think that anything's going to trade at a 7 cap. I think in 3 to 5 years, if the market's good, those are going to be well into the 6s. But I think that my underwriting needs to be on my numbers, and that's where I would like it to be. Very conservative underwriting as far as what rents people think they can get. The story of we're going to put $5 or $7 grand into a deal and we're going to get 150 a unit is dead. I think people need to be really conscious of that on what they can actually achieve. And so if they say, hey, this is the 33 IRR, I'm not looking at it. I'm just not going to underwrite. It's just not real. Those aren't out there unless you're buying something in bankruptcy and, or there's some crazy story. So if somebody says, JC, this deal's an 18 on our numbers, and I go in there and I mess with it, and it's a 16 on pretty rough underwriting on my end on a 3 to 5 year hold, and the financing is set, they've got not just we're getting quotes, but they've got a term sheet that they're ready to execute, then I think that would kind of be our perfect deal.
That makes sense. That also brings up the question of at what stage in the deal, right? Are they still just kind of sniffing around the deal, seeing if there's interest, or do they have it locked up? Are they, just LOI phase? So what's the best point for you to get involved?
Yeah. So, obviously the earlier the better, just so that I can have time to underwrite the deals on the weekend. But for us to really get serious and for me to take it up to David and Jared, because it's all about me leveraging their time, it needs to be under contract and it needs to be hard, and the lender needs to be prepared, because I had 3 phone calls today where somebody was like, hey man, it'd be really nice if I could use your terms to go back and retrade the seller. and it's the chicken and the egg. That's just not something that we're going to do. So I need people to be serious. I need people to be hard and under contract. And then at that point, I'm willing to take the time to dig into the deal and tell my superiors, hey, these guys are hard. They've got 100 grand hard on the deal. I don't know if people are going to have to do hard money anymore, but hopefully not. But I think that it needs to be, the debt needs to be lined up. They need to be ready to execute the debt, because obviously the equity partners can have some say on how that debt looks. And yeah, I think the earlier the better, but it needs to be fully under control and not going through the bid process. Because whenever I take it up to investment committee, we're going to be ready to go, as you know, Rob. And so it's once we get going and the machine's moving, we're going to look to close that deal on the equity side within 3 weeks. On the debt side, just because third parties are typically have to be ordered, 30 days.
So when you're underwriting, are you looking for first and foremost project level returns, or are you layering on the sponsor's proposed fees and then kind of solving for that net number? Or are you just focused, do we have a good deal on a project level, and then we'll just go and negotiate those fees and see where we land?
Yeah, so typically I underwrite our deals that our numbers need to make sense net of fees. So frankly, we have been in the general partnership business, so we understand that general partners need to take fees. We get that. We're not the group that's going to come in and say you can't take an acquisition fee. But we know that the market is not 3 points up front, and so we've seen a lot of people try that. And at the end of the day, if we charge fees, if y'all charge fees, whatever, my numbers that I'm solving to on my return hurdles are going to be on straight cash flow, and going to be something that's going to be a mix throughout the process. The taxes are going to go up. There's a building's going to burn down. Someone's going to steal money. You're going to switch management companies. Something's going to happen. And so I think that all that kind of ancillary income that you can get from these deals essentially is just going to net out those couple hiccups that are going to happen at the property. So that's a good question. We obviously will go in and negotiate the fees, but for me on the underwriting side, the project needs to make sense just on the bone metrics of the deal. And then if we need to sweeten the deal by doing something, or the sponsor needs to take an extra fee and we can, have certain metrics, or there's an earn out with a lender, it's really just, I'm basing it on the collections expenses that, and how the exits.
So a couple last questions. So this is, why do sponsors come to Flagship for capital, and what value do you add to your deals aside from just bringing in the capital?
Yeah, it's a good question. So I think that people bring deals to Flagship, one on the debt side, because we're a balance sheet group. So when people need money for draw requests, or if they're paying their note, or if a global pandemic happens and somebody needs some relief on interest, they're going to call me. They're not going to call Midland. They're not going to call Wells Fargo. They're not going to call some servicer that's in some bunker up in upstate New York that's working on these deals. And so that's really been a selling point to a lot of our borrowers, is the fact that we actually keep these loans on our balance sheet for the entirety of it. And so we actually care what happens to these deals, and we are willing to work with you. And so I think that's one of the main reasons that people come. Obviously, non-recourse is nice, and that's good on the debt side. On the equity side, I think it's because people really, at the end of the day, know they have a certainty of execution, have a lot of phone calls. I'm going to have a lot of late night phone calls with you about the underwriting. We're going to fly out to meet you. You're going to fly out to meet us. We're going to walk, as many units as we can at the property, and then we're going to issue the form sheet. All of that on the front end might seem cumbersome, and a lot of people get turned off of it. But once we do that, we're a go. We have never had a deal that we have done our normal process on, and something unforeseen hasn't happened through due diligence that we haven't closed at our terms. And so I think that's what people know about us, is that if we're going to do it, we're going to do what we said that we're going to do. So that's probably one. And number two, I think, is really the experience of David and Jared, principals at our firm. I think that people, a lot of sources out there, they're like, great, here's the money, send us a check. And while we're like that, we do like distributions, and we like for the deal to work. We do like to have calls with the sponsors, and a lot of people will ask David and Jared for their advice on different things. While we're not in the driving seat and we don't want to be by design, these two gentlemen in a lot of different cycles that owned and operated tens of thousands of units of multifamily all across the United States. And so I think there's a lot of inherent value there as well for people to ask them questions and know that if something goes super south, it's not just going to be, hey, give us our money back. It can be, hey, well, I remember this deal back in the early 80s when oil, everybody left Houston and we did it this way, and so I think that makes people comfortable knowing that David and Jared come from the operations and ownership side of this business. And so we're not just money guys. We're not just some financial institution in New York or LA that just send us our money. If it doesn't work, we're going to, that are just not friendly and just don't have the ethical kind of, compass that a lot of people are looking for out there. And so I think that's probably the third point that I would say why people use us.
Lastly, what is something that you're out in the market looking for in terms of a structure, a deal structure, or a strategy, and you're just not really seeing it out in the market? For example, maybe you would love to do a deal that has no upfront acquisition fee, but nobody's really willing to do that. Something like that.
Yeah. So I think, like I said, we've been on the other side of this. And so the no fee thing really isn't a problem for me. I think that one thing that I would like to see that I really haven't been seeing a lot of is people really kind of structuring and having the cash reserves available for a deal, because everything's probably not going to be as shiny as it used to be. So, it's for times like these is why you set aside, a few $100,000 that at the end of the day, those reserve accounts set aside is something that I really don't see a lot of people doing. And I think it's a product of the market being so efficient and so damn good for so long that people are just like, yeah, sure, 5% vacancy, 4% debt, no reserves needed. Fannie and Freddie are going to go easy on the, replacement reserves. Let's underwrite it. So I think that people really setting aside stuff for a rainy day, I think would make me feel more comfortable, and at least make me think that they've thought of that. And the guys that we're doing deals with have pretty significant cash reserves that they're putting aside, and the deals still work. And so I think that's what I would like to see. And then, I think really on the debt side, I like seeing people that have gone through a lot of different options, because I see a lot of guys that are like, hey, Q10 is our people, we do all of our loans with them, and I see the terms and they're really not the best, and at the end of the day, we're not there to dictate, what the general partner does on the debt side. But, or maybe going through a broker and having a true quote matrix of, hey, this is why we did Fannie instead of Freddie. Or, hey, this is why we, at the time picked Arbor instead of ReadyCap, or, whoever it is, because there's a lot of instances where you'll see for bridge loans, you'll be like, all right, I got a banging deal, 85% of cost, LIBOR plus 200. But then there's so many fees baked into that term sheet to where that cost of capital is not LIBOR plus 250. It actually ends up being the same as the other ones. And there's so many covenants and restrictions and cash. Sure, their rate might have been 4.25%, 4.5%, but at the end of the day, you're going to be dealing with them on the draw requests. They're actually going to fund that good news money and not have some crazy underwriting metrics that they know you're never going to meet. And we're not going to require a cash management account, And so I think that's my biggest thing is people really spending a little bit more time on the debt side instead of just blindly going for the cheapest rate, just because historically everybody has done that, and it just drives me nuts because I'm on that side of the business and I know that it's all facade, and I know what the servicing and the interest rate caps and the $15,000 to run a background check. I know a background check doesn't cost $15,000. It costs $450 to run someone's credit, in a full historic, that kind of thing. And so whenever I see that, it just kind of rubs me the wrong way.
Okay, yeah, two good points. It's funny, I'm just about to release an article about cash reserves, so I'm waiting for you to critique me on that. But I'll ask a few questions on that. So if I'm underwriting cash reserves, let's say I've got a couple months worth of expenses and debt service upfront reserved, am I a conservative underwriter if I project those cash reserves to be refunded to me at sale in, let's say, 5 years? Or should I assume that they all get spent at some point in time on a rainy day?
That's a good question. And I think that's where it gets into this is really an art and not a science, because I've got a way of doing it and David's got a way of doing it and Jared's got a way of doing it. I'll tell you that, for me, it's kind of a calculation on the vintage of the property. And I'm just talking about kind of ongoing reserves. So say, Freddie, Fannie, whoever says you're going to need $250 a unit, $325 a unit, depending on the deal. But if you're spending $2 million in capital on the exterior of that building, you're probably not going to utilize as much of those reserves on a go forward basis throughout the ownership, your ownership period. And so sometimes I'll underwrite, if it's, 250 or 350 a unit, I'll say that maybe you get 40% of that back, throughout the tenure of the deal. If it's a 1985 deal, if it's a 2001 deal, maybe you get 60% of that back, and so it's just really dialing in whatever number that you feel makes sense. On the going forward kind of rainy day cash reserves, I completely write those off. I think that's money that's just a cost of the deal. If you get it back, great. And one thing that we will do also is, as far as fees and refinances and, disposition fees, is we'll kind of incentivize our general partners on that. So maybe they don't take the biggest acquisition fee, but if they sell at a number that is really, really great at the end of the deal, we'll let them get a disposition fee of 50 bips. Or if they do a refinance event throughout, months 12 through 36, and they return 50% of the investor capital back, we'll allow them a 50 bit, refinance fee, and so we'll incentivize that on the fee side. But as far as reserves, I think rainy day reserves completely write off. Ongoing replacement reserves, just because on the lending side, we end up sending a decent portion of those back to a lot of our borrowers. And so I think that's what a lot of people, unless you're not doing any work on the exterior, I think that there's, it's safe to underwrite a percentage of those back in.
That's a good point. I think it definitely depends on what your Capex plan is in terms of what you've identified, because there's obviously going to be ongoing Capex and unidentified Capex once you get into the deal. And I'm finding you have a lot of experience, obviously, taking in those reserves and refunding them out. But I would imagine that 300 per unit, especially for a Class C asset, is just not sufficient.
Yeah. And I think that you're exactly right, but that's definitely not sufficient if you're not spending any money on the Capex. But if you're dumping $2.5 million into it, you'd be surprised how much you might have kind of laying around after the tenure of that deal.
Right. So I think it's a fine balance of your R&M and your OPEX and your turnover. If you're going to do all your turns out of Capex for the first couple of years, your R&M might be a little under or overstated for the first bit, Capex, and then eventually things kind of normalize out. So we're always tweaking with those three different variables: upfront Capex, ongoing Capex, and then R&M.
Yeah, and it's a stone cold art. I mean, like I said, there's David and Jared, both of my superiors, owned and operated thousands of units, and they do not have a formula. So it really is just kind of, it's a lot of gut feeling and a lot of faith, and it's really, a lot into your people. I mean, Rob, as owning and operating these things, it's really, you're only as good as your boots on the ground. And so a lot of those people, if they're out there checking and painting the sides and pointing that out and doing this, I mean, that ongoing, small maintenance throughout the tenure of ownership really can make a difference. But if you have, porters and maintenance guys that only fix when they get called, then that money can run out quick.
Yeah. All right. Well, we're still out there searching for the formula, but I'll let you know when I find it. So yeah, that's all we have for today. Thank you very much for your time. Good discussion. Yeah, hope to have you on again soon.
Thanks for having me, and I'm sure you and I will talk soon.